Okay, so let's dive into this super common beginner's dilemma. You've got some extra cash sitting around. You absolutely know you should probably be investing it, but man, the jargon and the endless choices are just completely paralyzing, right? You've got people tossing around terms like ETFs, limit orders, ticker symbols. It honestly sounds like a totally different language. But what if breaking into the market was actually, incredibly straightforward?
Well, welcome to this explainer. Today, we're going to completely demystify the market and turn this highly intimidating world of stocks into a simple, logical, paint-by-numbers tutorial. The goal here is so you can confidently make your very first investment without breaking a sweat. We are completely stripping away the complex Wall Street speak and focusing purely on what actually works.
To get us there, we're going to use a really simple foundational framework. We'll be covering 1, the silent wealth killer, 2, the power of compounding, 3, what should you buy, 4, when to invest, and 5, know your risk profile. All right, section 1, the silent wealth killer, inflation's impact. We've got to start with the why by introducing the absolute villain of personal finance, and that is inflation. The U.S. Federal Reserve actually targets a 2 to 3% inflation rate every single year, which basically means your uninvested cash is losing its purchasing power every single day. Let's look at an oversimplified but honestly very real example. So back in 2019, a Chipotle burrito cost about $8.50. If you had $50,000 in cash back then, you could have bought exactly 5,882 burritos. But today, that same burrito is closer to $12. So that exact same $50,000 sitting in your checking account now only buys you 4,166 burritos. You have literally lost 1,700 burritos of purchasing power just by doing absolutely nothing. That's what inflation is. You can afford so much less with the exact same amount of money. Moving right along to section 2, the power of compounding, why we invest. So, to beat this silent wealth killer, we turn to the hero of our story, the stock market. Historically, the market returns about 8 to 10% per year. And the magic math behind this wealth creation is called compound interest. Let's say you invest just $1,000 and it generates a 10% return. After year 1, you make $100. I mean, nice, but definitely not life-changing. But in year 2, you earn 10% on your new, bigger total of $1,100, which gives you $1,210. Fast forward a bit. If you just leave that original $1,000 alone, earning that 10% return every single year for 20 straight years, it mathematically snowballs into over $6,700. The money makes money, and then that new money makes even more money. It's a beautiful thing. Now, you might be wondering, why stocks? Why not real estate or gold or, vintage collectibles? Well, we focus on stocks because they offer incredible liquidity alongside those predictable long-term returns. Think about it. If you buy a $500,000 house in cash and then suddenly realize you need that money back, it's incredibly illiquid. You gotta list it, find a buyer, go through escrow, a process that takes 30 days minimum. Stocks, on the other hand, are highly liquid. You could literally buy a share of Coca-Cola stock in the morning and sell it in the afternoon to get your cash right back in your pocket. All right, section 3. What should you buy? Index funds and brokerages. First things first, you're going to need an investment account. This could be a tax-advantaged retirement account like an IRA or just a regular online brokerage account from places like Fidelity, Charles Schwab, or Robinhood. Once that account is funded, you face the big question, what on earth do I actually buy? Now, you could try to pick individual stocks, but picking the right company is incredibly risky. I mean, just look at Intel. If you had bought Intel stock at its absolute peak back in the year 2000, you still wouldn't have made your money back today. Crazy, right? Instead, pretty much every financial advisor recommends the ultimate beginner cheat code, index funds. An index fund automatically tracks a massive basket of stocks, like the S&P 500, which represents the 500 largest U.S. companies. By buying just one single index fund, you get instant diversification across heavyweights like Apple, Microsoft, and Nvidia, all with extremely low fees because there's no fancy active manager taking a massive cut of your gains. Now, to actually buy these funds on your brokerage app, you need to know what to search for in the search bar. You need to know their ticker symbols. Honestly, just think of ticker symbols exactly like airport abbreviation codes. When you fly to New York, your luggage tag says JFK, right? Well, when you invest in Apple, the stock market equivalent is AAPL. And if you want to buy that highly recommended Vanguard S&P 500 index fund, which trades exactly like a stock as an ETF, you simply punch in the ticker symbol VOO. That's it. Section 4. When to invest, timing versus time in the market. Okay, so beginners constantly fear that a huge market crash is just right around the corner. But fun fact, the S&P 500 actually spends about 8.3% of all trading days at all-time highs. So sitting on the sidelines trying to perfectly wait for a dip can absolutely wreck your portfolio. Let's put this into perspective. If you were sitting in cash and missed just the 10 best trading days in the market over a 30-year span, you would erase 54% of your potential gains, over half. If you missed the 30 best days, you'd end up with 83% less wealth. You simply cannot afford to be out of the market on its best days. It's too costly.
And this brings us to a really brilliant, liberating philosophy from the financial writer Nick Maggiulli, who says, rather than worry about whether now is the right time to buy, just keep buying. Even if you have literally the worst luck in the world and accidentally buy stocks when they are vastly overvalued, history is totally on your side here. For instance, back in 2012, a ton of experts were loudly warning that the market was 50% overvalued. If you had gotten scared and held your cash then, you would have missed out on the market growing 4.5 times larger since then. Historical data proves over and over that over a 20 to 30-year period, real returns almost always converge to the positive, regardless of the exact day you jumped in.
So to protect yourself from the stress of market peaks and just completely automate your success, you should utilize a strategy called dollar cost averaging, or DCA. This simply means you invest a consistent amount of money, let's say $500 or $1,000 a month, at completely regular intervals, just ignoring whatever the market is doing that day. When prices are sky high, your fixed amount buys fewer shares. When prices crash and are low, that exact same amount suddenly buys way more shares. Over time, your purchase price just naturally averages out, completely removing your emotions from the equation and drastically reducing your risk. Let's move to our final piece, Section 5. Know your risk profile, tailoring to you. Exactly how aggressive you should be with your investments depends on your consistent income, your goals, and most importantly, your time horizon. The stock market is never just a straight line up, right? It's going to have flat periods and it's going to have severe downturns. But younger workers have a massive, massive advantage here, and that is time. If you are in your 20s or 30s, you have the luxury of decades to recover from market volatility, which means you can totally afford to take bigger risks and stay heavily invested in stocks. Conversely, older investors who are nearing retirement, they really have to shift toward more conservative strategies, like bonds, because they genuinely need to protect that cash they'll be pulling it out to live on in the very near future. So, taking absolutely everything we've learned from this explainer, here is your actionable, super simple 4-step checklist to finally break through that beginner's paralysis. Step 1, open an online brokerage account today, like Fidelity or Robinhood. Step 2, use their search bar to find a broad index fund using its ticker symbol, something like VOO for the S&P 500. Step 3, set up a recurring investment to automatically dollar cost average a set portion of your income. And step 4, review and hit submit. Honestly, the whole shebang really is that simple. We've covered a lot of ground today, but the core takeaway here is crystal clear. You now know for a fact that a normal checking account actively destroys your purchasing power thanks to inflation. The stock market, meanwhile, is the most accessible, liquid engine for building long-term wealth that humanity has ever created. So the only question you really have left to ask yourself is this: what will your money be doing 20 years from today? Are you going to let it wither away, or are you going to take action right now, jump in, and let compound interest do the heavy lifting for your financial future? The choice is entirely yours. Thanks for hanging out with me for this explainer, and hey, happy investing.